Most retail investors buy a stock because of a headline, a hype cycle, or a gut feeling. And then they wonder why they lose money when the market shifts.
But on this channel, we don't guess. We treat investing like a business. Welcome to The Strategic Investor, where we ignore the noise.
When searching for great investments, emotional decisions lead to poor returns. That's why professional investors use strict checklists to eliminate bias. Today, we are putting BayCom Corp, ticker BCML, a regional bank holding company operating across 5 states, primarily centered in California, through a rigorous 30-point investment framework. The rules of this checklist are brutal. To receive an outright buy recommendation, a company must confidently pass at least 24 out of the 30 items. Out of the gate, BCML only manages to confidently lock in 7 clear passes. Why does this apparently cheap stock fall so short, and where are the hidden risks? Let's break down the data first. Let's look at how they make money. BayCom passes item number 1 with clarity. It's a traditional community bank. They take deposits from local businesses and individuals, then use that capital to issue loans, mostly commercial real estate, or CRE, and construction loans. Their revenue is driven by net interest income, the spread between what they pay depositors and what they earn on loans. However, because this is a bank, it completely misses the mark on modern super business metrics. Items 2, 5, 6, and 7, covering recurring subscription revenue, LTV to CAC ratios, and gross retention, are entirely non-applicable here. This brings us to a major red flag, the moat. Item number 8 asks for an identifiable competitive advantage. Guru Focus rates BCML's moat as a 3 out of 10, essentially no moat. While they possess localized expertise in the competitive California market, switching costs for a regional bank are low. Customers can easily move deposits or refinance with a competitor. Worse yet, item number 10 reveals that gross margins are declining, with a 5-year compound annual growth rate of negative 4.9%. Coupled with heavy geographic concentration in the volatile tech and real estate sectors of California, their competitive buffer is razor-thin. Moving to financial quality, we see a deeply mixed picture. Let's look at the bad news first. Item number 14 requires a return on invested capital, or ROIC, of over 15% for 5 consecutive years. BCML fails. Its recent ROIC sits around 9.91%, historically dipping as low as 5.4%. Furthermore, item number 19, interest coverage, fails miserably. In Q2 of 2024, its coverage ratio hit a company low of 1.87, well below our 8x safety threshold, but it isn't all bad news. The bank shows structural resilience where it counts. Its ROIC trend is actually improving, showing a 5-year growth rate of over 20%. Free cash flow conversion is incredibly strong, bringing in over $30 million against a net income of $26.4 million. Most impressively, item number 18 passes comfortably. Net debt is completely negative. BCML holds roughly $207 million in cash against just $20.4 million in total debt. They are fundamentally insulated from a pure liquidity crisis. Now let's examine capital allocation and management integrity. When investing in regional banks, you are betting heavily on the underwriting discipline and integrity of management. On capital allocation, they pass on share dilution. Shares outstanding fell by 1.63% year-over-year, meaning their share buyback programs are actively creating value rather than diluting investors. However, the management category is shrouded in question marks. Out of 4 critical checklist items, all 4 are marked as unclear or neutral. Why? Because BCML recently underwent sudden leadership turmoil. The CEO, CFO, and COO were terminated in a strategic pivot. While recent insider trading data shows some net buying over a short 3-month window, the long-term trend involves net selling by the company's founder. With new executives stepping into the driver's seat, we don't have enough data to confirm if their compensation is genuinely aligned with long-term per-share value. If the business model is average and management is in flux, why are investors even looking at BCML? The answer lies in item number 29, the margin of safety. From a pure valuation standpoint, the stock looks incredibly cheap. When you run a conservative discounted cash flow model based on earnings, the intrinsic value lands at roughly $45.38 per share. Compared to a recent trading price in the high 20s, that implies a massive 41% margin of safety. Even if we use a strict free cash flow model, the margin of safety remains strong at over 31%. Both models easily clear our checklist requirements. Furthermore, because it is a regulated community bank with $2.65 billion in total assets, it has built-in survival mechanisms mandated by the Federal Reserve, though specific public data on how it would survive a catastrophic 30% revenue crash remains unconfirmed. So, what is the final verdict on BayCom Corp? With only 7 out of 30 items confidently passing, BCML falls drastically short of the 24-point threshold required for a confident buy. It lacks a durable competitive moat, its returns on capital are below target, its margins are contracting, and the recent C-suite sweep demands a high level of investor caution. However, the balance sheet is clean, net debt is negative, and the stock is trading at a steep discount to its intrinsic value. Our recommendation? Pass or add to a strict watch list. Do not buy this blindly based on low PE ratios or DCF models alone. If you want to dig deeper, pull up their latest 10K and 10Q SEC filings to evaluate the new management's credit underwriting strategy.
This is not financial advice. Always perform your own independent verification.